Hello everybody, Brian here, quantlabs.net. Today is Friday, 3 p.m. Eastern Standard Time, the 21st of January. Okay, let's get to what I've been working on for the last few days. Number one, let me just transition here. Yes, no, there we go. Okay, so in here, what I want to show you specifically was this article I posted a few days ago. Portfolio optimization with quant analysis using Python. Now this is at quant-labs.net. Okay, so I put up a video of the tutorial from this person. You can get all their source code right here from this Python notebook. I work off the command line, so I've done my own little modification, get it working for my own little environment. I know this is probably the preferred way, but for right now, this is how I do it. So let me just show you my source code. I'm using Sublime, and this is what I've figured out so far. So if you have followed me for a while, and with the markets kind of dipping, interesting things I can show you here. So out of this, with the market being the way it is, in my case, let me just show you here. Everything's just all red on Friday today. So it's been like that for quite a lot of time this month. Just negative, negative, negative. So what I've done is I've run my usual OANDA analysis with MotoWave. I've come away with some what would make sense as defensive ETFs and some forex. Okay, now number one, when it comes to data with interactive brokers, they're really, really strict. So if you're starting with like nothing, literally, you want to get market data with interactive brokers, you have to fund the account with 500 US minimum. Then you get some subscription data, let's say US based, for stock. I think it's $15 or $10 a month, which is not really much. But with this article I just showed you, you can get the data for free from Yahoo Finance. And again, it really depends upon your trading style, how aggressive you're trading. You will not be able to do what I'm planning to do. Just going to do a series of requests to Yahoo Finance if I could go this path using Yahoo Finance data, maybe twice a day. And it's not very many assets here. It's only 13, so it's well within the limit of how many requests you can put out to Yahoo for free. And you do it, I don't know, once or twice a day, like once every 24 hours, 12 hours, depending upon how you want to recalibrate. And that's something you really got to work within because Yahoo's not that generous when it comes to their financial data. But for what I'm doing, it's well within the limit. So here's the one assets I've included. As I said, these are ETFs. You could choose your own. These are low-priced ETFs. And again, it's the same commission right across the board on interactive brokers when you trade. So here we have COPEX SGG, which is gold. Then we have gold, the ETF that's from Yahoo. We have wheat, soybean, FTAL. I have a spreadsheet here that will tell me. Just give me a second here. Actually, what I could do is I could just go through here. So FTAL. Let me just show you here, just so you know what these are. Some of these, I said, are ETFs. So there you got Europe, Spider, $71. So that's for Europe. FHCK is a Fidelity China. DAX is German. And then we have oil. As I said, we've got 4 currency pairs as well to sort of help out, diversify outside of the ETFs. So we have Japanese yen in USD, Sweden and Denmark against the USD, and then we have the pound against New Zealand as well. So this changes every time you put a request, of course, and you do that. But this is fairly decent looking as a defense portfolio with what's happening with the U.S. markets, because some of the international is doing pretty good actually. So that's what I'm looking at. So here, a lot of the code that I took from that notebook is exactly the same. I've modified it a little bit, so I've broken it up with a press a key so you can see the different breakdown, and so essentially we can, with all the portfolio optimization frameworks I've seen, you really gotta get your returns calculated, your covariance matrix calculated. Here we can figure out what our portfolio variance would be, volatility would be, our simple expected annual return as well. And a couple things that you need to really figure out here is the timing and when this starts. So here I'm only doing 4 months. You could do a year, and so on. Again, this is all relative. It's all really objective and arbitrary on how you calculate all these parameters. So I'm no expert here, but I might try to give you some tips. So as I said, it will go through the portfolios supposedly. Here I'm going to show you the uncomment this plot. So I'll show you the returns or the stock performance. So I'm going to show you that. So continuing along, what we have here is we now are using that package I mentioned, Pi Portfolio OPT Optimize, and what it will do is it will calculate the portfolio performance, and then this didn't work, and some code will work, some doesn't, depending upon the data that you send it. You get expected returns, sample covariance. I'll let the tutorial go into further detail. It's quite good actually. Portfolio performance, and it also uses a clean weighting as well. So that's what you use to help determine your asset allocation when it comes to picking out, if you have, I don't know, $500 to play with, how much you want to put into gold, how much you want to put into oil, based upon the analysis here. Gives also what your expected return will be. And remember, this is not 100% forecasting. If you read the documents of the Pi Portfolio Optimize, it clearly indicates that, depending upon what kind of solvers you use, your length of time. So as I said, it's very, very, very arbitrary, and the document tries to, or user guide tries to hint at what you can to prevent any wild Sharpe ratios that might be given, or any expected returns, because it's kind of like can be off. So yeah, all the code from this point on is pretty well the same. As I said, some of it may work, some of it may not, but let me just show you this run, and I might do another run as an experiment. So right now I fed it let's see here, so it's starting from a year ago, January 1st 2021. That's key. Okay, so it's got a year, just over a year of data. Okay, so let me just run this as is. So it takes a bit of time to download the data. Here it's calculating the weights, and then off it goes. It uses today's date and determines how much to download based upon that, from what I specified, as I said, since January 1st. So here's our covariance matrix. You can see here we got some not a numbers, so we have to be very careful on that. That can throw you off. Here we've got our, that's the covariance annual covariance matrix on an annual basis. This right here. As I said, I'm no expert in it, but I'm just trying to show you how it can kind of work. So we have here the portfolio variance, then the volatility, and then obviously you want to keep that as low as possible. The variance, it's very flat when you look at it. Here's our expected annual return. I believe that's 25%, maybe 1/4%, I'm not sure. So here it's running now the first portfolio analysis return. So this is expected. So the annual variance might be 3. The volatility be lower. And then here, this is the key part here, I believe. This is what I would do is when you see the negative returns here on the negative weightings among the entire 13 assets here, what you could do is you could rerun this and only keep the positive ones in your next run. So for instance, if you know you got COPEX positive, SGG positive, gold is positive, wheat's positive, but soybeans negative, take it out on your next run and just keep all the positive ones, and that should help boost your portfolio. But you can see here the annual return of $124%, annual Sharpe ratio 2.9. It's pretty wild, as you can imagine. And you can do the same thing here on the portfolio performance again, and just take out all the negative ones that generate a negative weighting or result. And then I believe there's a chart that comes up, maybe. See, and then another problem is you'll get warnings again on these solvers, so you gotta watch out for that. So here, this is really hard to interpret this chart. What I'm thinking is that you might want to focus only on those assets or instruments that give you the highest expected return, and then just drop the ones that will give you a negative return. That's probably the easiest way to get around that on your mix of instruments when you analyze this. That's what I'm thinking. And then again, it'll give you the annual volatility, which is quite high actually. The expected return here of 177%, which we know is not true. Sharpe ratio. But again, the best thing to do is just to take out those negative instruments. So, and here we have our efficient frontier with random portfolios. That's the Sharpe, the maximum one. Again, I go through the tutorial as I hinted at in the notebook. That might be very helpful for you, but all in all, I think it's not the smartest process, but considering it can be useful to know on a future basis which of these instruments may estimate to be negative returns down the line. I'm not sure how far down it estimates, but as I said, this is just a starting point. There's a lot of optimizing, and this is where you have to do a lot of back testing as well. Classic back testing. And we'll leave it at that. Let me just see here. I'm just trying to see the annual returns of these ETFs. Hopefully the plot will show it. But it's an interesting exercise, but you can probably do fairly well by choosing the right instruments for a portfolio, and leave it at that. So you can see here, gold is doing well, the Japanese yen's done okay, but there's very little returns with the ETFs. So, you might want to focus on the top 3, top 5 as well, to give you the best returns over a yearly basis. Or there's just so many ways to really approach this. So yeah, so and if you're really concerned about it, you can just use Motorwave as well, with the same kind of concepts. But as it stands right now, this is the best form of attack I can give. But as I said, when you get these returns here expected, yeah, just remove the negative and rerun it, and hopefully they'll improve, and you get a better basket of hopefully positive returns. We'll leave it at that. Let me know what you think in the comments. So I'll be interested to know how other people might attack it. But all this is the same source code as I said that's found in that tutorial. And I'm just using the Yahoo data, and we'll see what happens. Let me know what you think. Thanks for watching.